Everyone's got an opinion about where the housing market is heading in 2026. Crashes, booms, bubbles. But what if the truth is just a lot more stable and a lot less dramatic and even less interesting? I'm Shannon Ellison, and today we're cutting through the noise to uncover what's actually happening right now. As a matter of fact, 2026 is already off to a very noteworthy start. In this in-depth video, I'll be covering prices, inventory shifts, new variables in mortgage market, and signs that the market won't crash. Let's start with supply and demand, one of the most misunderstood data points. People keep saying that there's no buyers out there. And yes, demand isn't what it was during the COVID rush, but demand is up. Mortgage purchase applications, a true measure of near future activity, have been trending upward month over month and year over year for more than 6 months. Sales are down 53% from the post-pandemic peak, but up 27% from just 3 years ago. Supply has been historically low over the past 3 years. A big factor is that lock-in effect. Homeowners with 3% mortgages who have little incentive to move because their current payment is too good to give up. And did you know 79% of home buyers are also home sellers? We're also seeing inventory rise, bringing more options and more activity. That's a good thing. This is not 2008 all over again. Inventory is up 8.5% and down 85%. For a market crash, we need a lot more than that. Quick disclaimer, all of this data comes directly from the Multiple Listing Service and reflects single-family homes specifically in Santa Clara County. Another interesting headline from Redfin claims this is the strongest buyer market on record. Well, their data only goes back to 2013. And for Silicon Valley, the market is actually quite healthy. With our team's decades of experience, I can confirm that these calmer cycles are necessary to maintain that long-term appreciation after experiencing those wild 30 to 40 offer markets. So yeah, this has been a pretty balanced market overall. It's pretty flat last year, which is exactly what I predicted. And it's the best start to a year in quite a while. Pending weekly sales are at a multi-year high. Purchase application data is at a multi-year high, and price cut percentages are slowing year over year. The overall data curve began improving around mid-June last year, and that trend has continued. Of course, always keep in mind that we are Silicon Valley, one of the nation's unicorn markets with significant regional variations. And remember, regardless of where you're located, certain homes will sit longer due to specific factors like location, schools, size, detractors such as power towers or busy streets. But the big question is, what's happening next? Since affordability is still tight and the lock-in effect remains strong, the market's going to continue to be influenced by interest rates. No surprise there. So let's break it down. There are 3 parts to affordability: home prices, which are steady, wages, which are increasing, and interest rates. That means the biggest potential variable this year is mortgage rates. Though predicting the rates is a fool's errand. I heard someone say forecasting mortgage rates is like trying to predict next year's weather. It might sound confident, but it's nearly impossible to be precise. Rates started the year around 6.25%, briefly touched 5.99%, and currently are hovering at about 6.1% at the time of this video. That's a full percent lower than last year and 2 points down from 2 years ago, a 33% improvement. Are you still waiting for a 3% mortgage? Fold that up, set it on fire, and throw it over your shoulder. We're probably never gonna see that again, and if we do, refinance immediately. So, flat housing plus increasing wages plus lower rates equals small but real improvements in affordability. It's not huge, but it's progress in the right direction. So keep an eye on mortgage-backed securities. I'll have a full video on that later, but despite the new cycles and volatility, the housing market remains remarkably stable. Once again, stability and comfort. Now, if rates drop closer to 5.75%, expect a surge in activity, more competition, stronger pricing, and a renewed movement from locked-in sellers who finally see a gap small enough to make that move, put their house on the market, and buy another at a reasonable rate. That would open up more entry-level homes and revitalize trade-up activity while sidelined buyers jump back in and chase the dangling carrot. So home sales should climb. The demand we saw increasing last fall will likely continue this spring. We've already seen it, especially compared to last year. Now, what about all the doom and gloomers? We love the doom and gloomers, don't we? You've probably seen the headlines. Active foreclosures are up 20%. If that caught your attention, take a breath and look at the full picture. That increase reflects the lifting of a moratorium on FHA and VA loans, which is normal, and those numbers have already stabilized. Nationally, foreclosures remain 40% below pre-pandemic levels, and delinquencies are still trending downward. Also, less than 2% of all purchase loans in Santa Clara County even fall into that category. Simply put, there is no forced selling. Affordability is improving gradually, and local homeowners are sitting on near record levels of equity. Our market remains one of the strongest in the nation from an equity standpoint. Last year, a lot of people focused on extremes. I stayed focused on data and trends, and once again, that approach paid off. Everyone's going to appreciate another normal housing market this year. In fact, housing affordability is now the best it's been in 4 years. A boring housing market is something we can all enjoy. Boring and normal build future appreciation. Just dig into the data, read and understand the details. It always beats relying on snippets and sound bites that lead to uninformed conclusions. So while others chase headlines, I'll keep chasing the data because boring markets often build the strongest wealth anyway. As always, I'm here to educate and navigate, not speculate and fabricate. Keep watching. The story of 2026 is just getting started. And if you made it this far, thank you. Don't forget to like and subscribe, and I'll see you next time.